Okay, we might get underway. I think there's still a few more people to join, but we'll get started. Thanks everybody for coming along to our virtual pre-briefing on the March quarter national accounts today. Just before I get started, a couple of housekeeping things. If everybody could mute your devices that you've joined us on today, that would be great. And I have up here on the slide that hopefully you can see that if you are having any technical difficulties, can you please contact David Price with the phone number there. Okay, so we'll get underway. Okay, so I'm Michael Smeeds. I'm the Program Manager for the National Accounts Program here at the ABS. Today's presentation may not go for the full hour and a half that it's booked for. I think that when we started planning this session, we were planning for some eventualities that didn't actually occur. Thankfully, I think, like many of us, we were planning for some worst case scenarios a couple of months ago. And as you'll see as I go through the presentation, that some of those haven't eventuated in terms of any risks to our data sources or other elements. So, yes, I might not go for the full hour and a half, but we'll see. I'm going to pause halfway through the presentation, ask for some questions then, and then also take questions at the end. We'll see how that works. I guess, given the virtual nature of this presentation, we decided against sort of taking questions as they arise through the slides, but we will stop in those 2 points and ask if anybody has any questions. So please do hold on if you have any questions I go through, and you will get an opportunity to ask those. Okay, so today we'll run through the March quarter 2020 national accounts, or our planning for it. So I'll talk about our data sources, talk about our methods, and talk about some treatment of new policies, particularly emphasising anything that might have changed or anything that we feel the users need to be aware of that's different for the March quarter than what you would have experienced in the past. I know there's a lot of interest around June quarter, and we'll look to do a similar one of these presentations prior to the June quarter release. But really today we are focused on the March quarter. Okay, so here's a bit of a summary timeline. It really is for illustrative purposes. It's certainly not definitive of everything that happened through the quarter. I think the reason I wanted to show this is just to show, I guess, put out there, you're all aware, but just to put it on one slide, everything that happened during the quarter, and to make the point that timing really matters at the moment in our measurement. Many different events happening at different periods. So early on in the quarter, obviously in January, every discussion was around bushfires and smoke. And then later on, we moved into some hailstorms and some other storms in Queensland and here in Canberra. So, roughly a month, I guess, into the quarter, so roughly around the end of January, we really started to see discussion lift around what is now called COVID-19, the coronavirus. And we saw some of the first reactions to that in terms of beginning to close the border, initially with China. Some decisions made around increasing spending on health by governments. And that sort of, continued on through February, and obviously concern escalated through the quarter until right at the end of the quarter. In the last couple of weeks, we saw the full border closure, we saw the full lockdown, and obviously quite a change in economic behaviour right at the very end of the quarter. So the point here being that, we're going to get a range of events in March, and I'll do my best to walk you through those today. And we'll also do our best when we release our results in a couple of weeks to really step through some of the different impacts on the accounts from these different events. Okay, so having said that, we'll jump into now any changes to our sources and methods. So news that made us very happy, and hopefully makes our users very happy as well, is that there were no major disruptions to data sources. So all of our usual data flowed through. That's both our normal surveys and collections, as well as administrative data that we use. We did see slight decreases in response rates, and I am talking slight there, so we're talking, a couple of percent, I guess, on average across our collections. That was really heartening for us in terms of our ability to produce a quality set of accounts. We had done quite a lot of preparation work for the eventuality that response rates would be worse, or in a worst case scenario that we wouldn't be able to run some collections at all. Fortunately, those didn't occur, but we were able to put some things in place to mitigate our risks. So we put in work around additional imputation and quality assurance mechanisms. And these really relied on us getting some additional data sources, particularly single touch payroll and business activity statements, so that particularly in the event of non-response, that we could really make an assessment and make some sensible imputes based on a determination of whether that was a non-response of an operating business or a business that had died during the quarter or some other scenario. So we're really fortunate that the ATO helped us out a lot with some early access to these products around single touch payroll and business activity statement. They were very useful. We're also lifting our use of electronic transactions data. So the ABS has for some time now obtained retailer scanner data, as you'll be aware. It's heavily used in the CPI, but it's also more and more used in the national accounts to inform, particularly on some of those product shifts that we're seeing in household final consumption expenditure through the quarter. So that's data that we did have and we're making more use of. On the electronic transactions data, there's a news point out today, sorry, not a news point, a media release out today that you might have seen, noting that a number of the financial institutions are sharing electronic transactions data that they obtain with us for the purpose of quality, ensuring quality across our macroeconomic statistics. And we'll be looking to rely on that kind of data through the coming sort of 6 months, I guess, as events proceed. So that's good news on our data sources. That we're in the fortunate position that we're not reliant on face-to-face interviewing for our economic statistics. That we have largely moved to using electronic collection mechanisms. So that's stood us in good stead. So you should see the same relationship between our data sources, our input data series, and the national accounts as you would normally expect to see through any other quarter. So there's no significant changes to report there. We are also reviewing models and updating assumptions where necessary. You'd all be aware that we need to make quite extensive use of models across the accounts to measure the different phenomena. So I'm just going to take you through some of the changes to some of the models. Some of these you might be aware of already, but other ones will be new. So I think one of our first concerns was around international trade in services. That's where we saw some of the first expected impacts, or we saw the first changes with the COVID policies, with the border lockdowns. And so our international trade in services team, international accounts, have had to do a reasonable amount of work to ensure that their measures of travel credits and travel debits were representative of what actually happened in the quarter. So people may be aware that the biggest contributor to international trade in service is the travel services component, and it accounts for approximately 50 to 60% in any given month for both debits and credits, with education services the largest component of travel credits. So people would have already seen the monthly data that's come out for January, February and March across our trade and services, at least in current prices. I think maybe some people were surprised that our Travel credits, that is our exports, didn't fall as much as maybe expected, but that reflects that there are already a significant number of international students in the country prior to the border closures coming in place. And those students continue to contribute, if you like, to those travel exports, so travel credits, while they're in the country. So we're doing quite a bit of work in that area to ensure that the data there is representative of what has actually happened. And to manage the impacts on data quality, the ABS has been working across government to access additional data to support the compilation of those estimates. In particular, we're getting quite significant data flows from Home Affairs, who are providing weekly data on the number of students, visa holders that are inside and outside of Australia, and providing additional provisional international travel movements as well. So we have a good take. We have that weekly data on the numbers, and then on the dollar side, if you like, on the expenditure side, the Reserve Bank is sharing earlier data on from their card payments data to enable us to look at what the spend is from international residents in Australia, so that we can make some assessments on that spend that's happening in that travel credit and travel debit space. So there's quite a bit of work going on there, and that's already in that monthly data that you've been seeing through the quarter, and that'll be reflected in the accounts as they get released. That's the first model I wanted to mention today. The second one is the estimated resident population. It's another one that hopefully you're aware of. Estimated resident population, you have the additional complexity, if you like, of the residency rule, where you need to spend 12 months in the country over a 16-month period to be classified as a resident. Clearly, when people come in, we don't know always exactly what their intentions are, and so historically we've modelled that based on past behaviour, and that's a really robust model. Past behaviour is a pretty good indicator normally of the expectations that students will stay in the country or other visitors will stay in the country long enough to meet that residency rule. But clearly, COVID and the lockdown and other elements that are occurring in the world right now will change those models and change that behaviour. So one of the things that we're doing with the ABS is doing with the estimated resident population estimates is to move from an annual revision sort of practice to a quarterly revision practice. So you can see, and this is to ensure that the data we release is up to date as we can have it. So we're not storing up the revisions; we're putting those through straight away. You might have noticed that this was reported in the Labour Force survey. Clearly, it's really important for the population benchmarks there, and it also come into the national accounts, and the national accounts will use the most recently available ERP estimates, and so they'll be revised in the accounts as they are in our demography estimates. I did have a question before the seminar on the use of population numbers to project any components in the accounts. So there are a couple of small components of household final consumption expenditure where our practice has been to project those estimates on a quarterly basis using changes in population. And so those components have been the sporting component within culture and recreation. So that's about 14% of recreation and culture in household final consumption expenditure. And then the services component of other goods and services in household final consumption expenditure. So that's been the practice. We're obviously, well maybe not obviously, but we are reviewing that practice for this quarter, not so much because of any concerns over the population estimates, but just that we don't think we can assume that those components are moving in line with population changes anymore, because obviously there have been other changes that have come in that will change the way people consume sport and other services. And so we are making use of the business activity statements there, so some output of firms that work in those, operating those fields, and also bank transactions data, and moving away from a reliance on population estimates for those two components where we have historically used them. Okay, so that's the population side. This one is probably news to people. So you'll be aware, and it was discussed at the time, that when we released the March month labour force survey, that there was an unobserved reduction in hours worked in the last week of March. I think you mostly be aware, but labour force surveys mainly collected in the first half of the month. And that's when the estimates are. So March was largely collected up to around the 14th or 16th, whatever the date was, around there in mid-March. Clearly, most of the lockdown, most of those COVID suppression policies, the most major ones were put into place after that. And so they were all picked up then. Subsequently, those changes in hours worked were picked up in April labour force, when that was collected in the first half of the April labour force survey. In national accounts, we're very concerned to align our measures of hours worked with our measures of production and output, to make sure that we get good measures of labour productivity, get good measures of unit labour costs, and all those other areas where the hours worked provides important analytical information on what's happening in the economy. So we are working with our colleagues in labour statistics to make an adjustment to those hours worked for the March quarter. And this is where we've been able to make good use of the labour accounts, which has been around for a couple of years now, but is really, I think, maturing in its usefulness, and will be, national accounts will be moving to using hours worked in the labour accounts, and those labour accounts will make adjustments to those hours worked numbers based on single touch payroll and based on the April hours worked numbers, so that we'll see a change there. We'll see a shift in the phasing, if you like, of that decline in hours worked within the labour accounts and the national accounts. Some of that will move into the March quarter rather than being all in the June quarter, as it would be if we didn't make the adjustment. So we'll be providing more information on exactly how that adjustment's been calculated when we release the data, but you will see that in the national accounts and then in the labour accounts when they're published, and we're still determining whether we'll put those changes through the subsequent labour force survey release, or whether we'll leave that on an as collected basis. So there's an important change where you will see a change in the relationship between what you normally expect in data source feeding through to the national accounts. Okay, and I think finally in terms of models, if you like, our seasonal adjustment and trend estimates. This is another change that you would have already seen happen in other collections. Clearly, the shocks to the economy pose significant challenges in determining changes to seasonal patterns, in determining trend, in unpicking those irregulars from ongoing changes in the economy. So we've been undertaking seasonal analysis of all our components as the data's been flowing through. And we are moving, as appropriate, our approach from concurrent factors to forward factors. So concurrent factors take into account the most recent quarter, if you like, and bring that into the formula, into the algorithm for calculating the seasonal adjustment indicators, measures. And so where we're not sure if there's what the change in the economic story is, what the shock is, we are moving to implement some forward factors, which are based then where we're essentially holding constant, if you like, the seasonal factors seen in the previous quarter or calculated in the previous quarter. So we are implementing some of this in the accounts. It's going to be component by component, so there will be some components on concurrent and some component on forward factors, and we're working through that. And when we release, we will be clear on which components are using which approach. So that's seasonal adjustment. On the trend, we are suspending the trend until certainty emerges in the underlying trend of the economy. This is in recognition of the time series shocks in the economy. The large changes as a result of COVID-19 are making it obviously difficult to estimate a reliable short-term indicator of the trend. And we don't want to mislead people around that trend estimate. So we will be suspending the trend in the upcoming national accounts release. So those are where we're at in terms of our data sources, some of our models and our methods. I might just pause for 30 seconds there, and if people can indicate if they've got any questions, then we'll pick those up. So I'll just give people 30 seconds or so. I'll have a drink of water to see if they have any questions. Okay, looks like we're all good at the moment, so I'll stop again at the end and we can pick up any further questions then as well. Okay, so the next component of the presentation, I wanted to quickly talk about some treatment of some government policies, and particularly what policies you might see that might impact on the March quarter estimates. So firstly, I don't want people to forget about the bushfires and the bushfire response. So if people cast their minds back to the bushfires over the new year and then the subsequent recovery from the bushfires, that we can expect, I think, to see as a result of that response, you know, some of the activities undertaken by the Defence Forces, for example, who cleared and repaired over 1,300 kilometres of fencing, close to 5,000 kilometres of roads, and delivered a significant amount of water, fuel, fodder and meals. So, you know, that's a significant amount of activity that will be recorded in the quarter. Then we saw it, and that's through the Commonwealth, if you like, through the federal level. Then we saw across New South Wales, Victoria, South Australia and the ACT, some additional recovery efforts as well that will be reflected in the March quarter. I think, you know, I think it's been in the public domain that the scale that is fairly significant, I guess, given the widespread destruction, the sheer area covered that needed to be recovered and repaired through those events. And we're obviously expecting a fair bit of that in the March quarter, particularly in Victoria, I think, where things moved a bit ahead of elsewhere. So we would expect to see some of that activity in the March quarter. Not all of it, some of it, particularly in the other jurisdictions, you know, I think we can expect to see later on, given the challenges of that amount of work and the timeframes it takes to do that. In addition to that kind of repair work and clean-up costs, there were also a couple of other policies. So there's payroll tax deferrals in different jurisdictions, and I'll come to it later on, but then there were further payroll tax changes as a result of COVID policies. But just a reminder that those policies were there for the bushfire. And then we saw a range of different grants, mainly from the Commonwealth, additional compensation for property loss and injury, providing small transfers to small business and grants to local governments. And this is in addition to the state government grants. So, you know, some examples here: the Australian Government Disaster Recovery Payment of, you know, $1,000 per adult and $400 per child is paid to about 39,000 people as of April. Commonwealth Disaster Recovery Allowance, which was a compensation for income loss. State disaster recovery relief payments, and a range of smaller Commonwealth and state-based grants. So, we'll do our best to inform on all of these as we release the data, but just at this point, just a reminder not to forget about January and the events of the bushfire, given they'll be there in the March accounts. That's bushfire. And then onto the COVID-19, some of the policy responses there. So I haven't asked for a recent count, but the last time I asked somebody for a count of new policies as a result of COVID, I think we're up to around 300 new policies across all levels of government. It's been an enormous amount of work for us, and it's ongoing work. Each of these policies needs to be assessed and an appropriate treatment determined, and both a conceptual treatment of how we'll record it, but then to make sure that those estimates are coming through or will come through our source data correctly into the accounts. So we've been working through these. We've made pretty good progress. We've tackled all the March quarter ones and moving through some of the June quarter ones, but there is a lot of work to be done there, and it is ongoing. So we've commenced publishing the treatment of some of the more significant and more complex treatments, and they can be seen on catalogue number 5261 on the ABS website, and I'll touch on these, or I'll mention each of these in today's session. So the first, before I get to the specific policies, just a bit of a summary of what you can expect to see in March quarter, or which policies should impact on the March quarter results accounts. So there was a payment to support eligible households. There was an increase in Commonwealth Health funding that I mentioned earlier on, particularly in the preparing the health sector, if you like, for the challenge they faced. There was health advertising costs, pop-up clinics, training programs. There was expanding existing programs, all those at the Commonwealth level. The payment to support the eligible households, that's the $750 payment to eligible recipients, some of which will be in the March quarter, and some of it will be in the June quarter. So that's Commonwealth. Then at the state level, there's a range of state policies to obviously, once again, increase health care preparedness, and there were changes to the state payroll tax process in terms of refunds for some payroll taxes that were paid and some deferral of those. So that's sort of the primary ones that you expect to see in the March quarter. Some of the really large ones obviously aren't there, so I'll get to some of those now. JobKeeper is the largest and probably the most discussed. Everybody's aware of what the JobKeeper program is, so I won't go into the details of it. But the way that we'll be classifying the JobKeeper program is the JobKeeper payments themselves from government will be a subsidy, another subsidy on production that will flow from the government to the employer. Now, so that's the JobKeeper payments. In the accounts, there'll be a subsidy from the government to the employers. Obviously, there's an expectation, an obligation that those employers then pay a wage of at least $1,500 per fortnight to their employees. That payment in the accounts will be recorded as a wage and salary item, so in compensation of employees. And that data in the accounts is simply flowing through the normal payroll processes. So it is wages and salaries. I think in the language we use, there aren't JobKeeper payments going from the government to households. JobKeeper payments are going to business or to employers, and then those employers are subsequently paying wages and salaries to their employees. So that's the treatment in the accounts. One thing I should mention, which is on the slide here, that's where there is the case of an employer and employee. Obviously, the JobKeeper can also go to self-employed persons, and that element of those payments will end up in gross mixed income. So the timing of the subsidy payment. So the scheme began at an accrual date on the 30th of March. but we won't be showing any of the subsidy in the March quarter. So there are technically 2 days in which the subsidy will be accruing, but we won't be showing those 2 days in the March quarter. We'll be commencing recording of the subsidy in the June quarters and the September quarters. And the reason there is that we're working with the ATO to get access to the data required so that we can produce those estimates and that we can allocate them to the appropriate industries. So this is a subsidy that needs to be reported to against an actual industry, if you like. We can't just give it to the whole economy. So we need to be able to access data to get those numbers and to allocate it to the right place. To the extent that any wages or salaries were paid, then we'll pick those up through the normal processes. So that's how the JobKeeper will be viewed in the accounts. And I should say this is based on the current operational understanding of the scheme. Obviously, this is a really big scheme that's being put into place really quickly. So we're continuing to work through all the nuances around that. Obviously it has an impact on wage price indexes, on average weekly earnings, on all our measures. So we're continuing to build our understanding and determine the treatment of that scheme. The next one I'll mention is the boost in cash flow for employers. So this is the payment from the Australian government to eligible businesses. When it was announced, the estimated value was $31.9 billion. 2 boosts based on the business activity statements. So it's another significant program in terms of dollars. Within the accounts, this will be treated as a payable tax credit. So it's not a reduction in tax revenue. It's a tax credit, and that credit is recorded as a other subsidy on production. Still clarifying the timing of this with the ATO, but it's another one we don't expect any in the March quarter. We expect the majority to be in the June quarter and the September quarters. And again, where we're working with the ATO to get an understanding of those payments and how they're flowing through the different industries. Okay, a bit of a different one now. Early release of superannuation provisions. So people would be aware that there's always been some provision to access superannuation in some circumstances. That's been expanded and more people are eligible to make those withdrawals for more reasons, if you like. Estimated value of expanded provisions there is $27 billion. So again, a sizable number. And 2 early releases prior to June and then after July. So this is one that you won't see in the national accounts released on the 3rd of June because it's a balance sheet change. This will be classified in the accounts as a balance sheet change as a fall in the pension entitlements offset by an increase in cash and deposits. And so you'll see that when we release the balance sheets with the Finance and Wealth publication coming out subsequently. Again, we don't expect to see any of it in the March quarter. The majority is expected to be seen in the June and September quarters. That's our treatment there. Okay, on to payroll taxes. We've got an example here based on Victoria. So each jurisdiction, I think every jurisdiction, or at least most of them, probably all of them, have announced some changes regarding the collection of payroll tax. We're using Victoria as an illustrative example. The same rationale and the same reasoning applies to the equivalent schemes in the other jurisdictions. So again, this is a non-payable tax credit, so it's a tax credit, and the payroll tax remains another tax on production. There are timing difficulties with these ones, given it's a non-payable tax credit, which, as we work through how this is reported through our government finance statistics, this one, and allocated through the ATO and others, then we'll need to determine how to allocate this across the quarters. This might end up as some revisions to our published series. Ideally, with these tax changes, we'd follow a tax liability method and actually allocate, the appropriate taxes to when the liability for that tax occurred. But we're still working through those issues. Okay, so those are sort of a range of policies, if you like, new support policies from the government, additional payments, tax relief, that kind of thing. Clearly, the lockdown has those kind of policies. The COVID suppression policies have also impacted on the economy, and we've also had to consider how we would measure those changes in the accounts. And I think one of the biggest ones that everybody's experiencing and that people have been asking questions about is the move to online learning for education. So we're all aware schools closed except for essential workers and particular needs. Students were all being educated at home rather than face to face. There's some question: is that actually a quality change? And when in our volume measures in the accounts, should we reflect that as a quality change? So our education output volumes are based on student numbers. So this is enrolments, if you like, and so we will reflect any changes to retention rates. If there's an increase in school dropouts, etc., that kind of thing will flow through our volume measures. But we don't have any measures in the way that we calculate education services that differentiates between face-to-face learning or online learning. And we don't intend to make an adjustment for quality change at this time. And this is in line with international recommendations, so it'll be in line with the treatment in other countries on this. There are some interesting questions, I guess, around this, and what is productivity change? What is the change between the inputs, if you like, and the outputs? And so we're picking up some of the longer term questions through our productivity measurement program and some of the investigations that we're currently doing into non-market output and how we measure non-market output. And so that's education, but you can take the same principle and apply it to, say, telehealth. In terms of our volume indicators for health, output of a doctor's visit in person will come through in the same way as a doctor's visit using telecommunication technology. We're not attempting to make a quality adjustment there and changing our volume measurements. So that brings me to the end of the policies I wanted to run through. Clearly, there are a lot more policies that have been implemented, and we're continuing to work our way through those. The more significant ones and the ones that we think give a idea of how we treat similar schemes, we're publishing in that 5261 catalogue number that I mentioned. Also had a question around childcare. Clearly, there's a big change to childcare arrangements with the COVID policies as well, and the move to providing free childcare to parents. That don't impact on the March quarter. It's one policy that we're still working through our treatment of that, and so we'll be determining that over the coming weeks. And once we've made a determination on the treatment of that childcare change, then we'll let people know, and we'll publish that in that 5261. And that will be in the, that treatment will begin in the June quarter release. There's an awful lot of policies, and so we're prepared to have any discussion, if you like, on any particular policies as we go through. Some of them we can answer now, some of them we haven't made a determination of. As I said, there's those 300 to work through, so you can imagine the workload to crunch through all of those. But we'll keep the communication going on that. That actually brings me to the end of what I wanted to present today. As I said at the start, fortunately it didn't take an hour and a half to run through everything, and that's mainly because some of the fears that we had around disruptions to data sources and other changes didn't eventuate. But I will now, we've got plenty of time, obviously, for questions now. My email address is also up there if anybody wants to get in touch with any questions or any discussions, more than happy to do that. So if you do want to ask a question, can you please indicate? There's a raise your hand icon that everybody should be able to see, hopefully. Looks like a left hand. If you click that, then we'll see that and we'll be able to take your questions. So please let me know if you do have questions, and we'll give it a few seconds or a minute and see if anybody has any questions. Yeah.
Elizabeth Smith, can you please unmute your microphone and ask your question? Thank you.
Hi, thank you. This is Lizzie Smith from Treasury, Western Australia. I just had a question. I just wanted to clarify. So it sounds like you guys have new bank data that will be potentially being used to confront and flow through the household final consumption estimates. And I just wanted to clarify whether does that mean that there'll be potential revisions to the back series as you have this new source data as you'll need to confront and sort of keep that consistent over time?
So I don't think that the new data sources will lead to revisions. I think the way we intend to use those is to confront, our data sources in real time, if you like, rather than going back and doing analysis back. All our data sources, retail trade and others around household final consumption expenditure have flowed through at around the same quality as they normally do. So there's not additional risk there. We don't know exactly how it'll play out over the next 6 months, but that's the situation at the moment. We'll be using, that banking transactions data when, for some of those areas that are hard to measure. I mentioned the ones where we've been using population estimates, in some of those sports kind of spaces, and using those there, and really as an additional source in the event that, with the changes in the economy, there are questions from our source data. But it's not so much around revisions, it's confrontation in real time, ensuring the quality of what we release. I think on the revision side, we don't see anything at the moment that would lead us to think that there'll be an increased level of revisions. But obviously, there's significant turmoil, if you like, significant change in the economy, and that's a risk. Potentially, seasonal adjustment, what happens with seasonal factors through it could have an impact. But otherwise, our data sources are looking as robust as they usually are, so we don't see any specific reason to be concerned about an increase in revisions.
Deferrals, how are they going to be treated through accounts? Good services deferral. Yep.
I might have to take that one on notice. As I said, there's so many schemes that I'll happily get back to you on that one, Michael. Exactly.
Thank you.
It's been one of our big challenges. Normally we see sort of 5 or 6 of these policy changes in any one period, so 300's quite a bit of a challenge. But yeah, I'll get back to you on that one, Michael.
Thank you, Michael.
Thanks, Michael. Okay.